Welcome to the FNO InsureTech podcast, a place where movers and shakers from all points within the insurance ecosystem gather and discuss all things InsureTech. We talk about how technology and innovation are affecting and driving change in the industry. Here are your hosts, Matt D. Fothery, Lee Boyd, and Rob Beller.
An actuary, an underwriter, and an insurance salesperson are riding in a car. The salesperson has his foot on the gas, the underwriter has his foot on the brake, and the actuary is looking out the back window, telling them where to go. More true than a joke. Ha ha ha. That was on Google.
And that will serve as our introduction, ladies and gentlemen, to to this week's edition of FNO InsureTech with
I got another
Lee
one.
Boyd and Rob Beller. Oh, wait, we're not done. There's more. We're doing actuarial humor today because, as we all know, all the great jokes that you've ever heard are about actuaries. So please go ahead.
Two actuaries are duck hunting. They see a duck in the air and they both shoot. The first actuary shot is 20 feet wide to the left. The second actuary shot is 20 feet wide to the right. The actuaries give each other a high five because on average, they shot it. Who knew?
I don't even know what to say, which doesn't happen very often.
Well, you know,
Why are you telling us these jokes, Lee?
Because we recently just talked to a couple of actuaries, and I thought there's got to be some jokes about these guys. And sure enough, there is on Google.
They like to joke about themselves.
They like to joke about themselves. They do. But you know what? Today on our podcast are two actuaries who are just people persons. People.
That's right.
Persons
That's
of
right.
people. Does that make sense?
That's right. Lance Poole from Juniper Labs and David McFarland from Coterie, two insurtechs that are run by actuaries. Imagine that.
Imagine that. I'm excited about this today. It's a interesting conversation. It's surrounding COVID-19. It's surrounding InsureTech. It's surrounding the future, all with a very thoughtful underlaying, I guess, of where we've been and where we're going. It's a good conversation today. It's one that is, I wasn't real sure what to expect out of this conversation, but I'm pleasantly surprised by it.
Lance recently authored a white paper on pandemics and insurance. That is a fascinating read, and we'll link to it in our podcast social so that you can read it, because he has a lot of interesting things to say. And when we saw it and we heard about it, we thought this would be really interesting to talk about, particularly in light of the fact that we're in the middle of a pandemic.
We are.
And so rather than us jibber-jabbering, that's kind of a Lee term, jibber-jabber, isn't it?
Yeah, it is.
It's a term you'd use, jibber-jabber.
Yeah, absolutely.
If any of you out there are wondering what's Lee like, he's the kind of guy that would use the phrase jibber-jabber.
Mm-hmm. We could call that a Leeism.
I prefer to say Lee's a nerd. That's a Leeism.
Well, I think today you might use the word nerd a couple of times.
Yeah, just wait and see. So without further ado, here's our interview with Lance Poole and David McFarland, two actuaries who run InsureTechs. Hey, everybody. We are here today with a whole group of people. Lee and I have on two special guests with us. David McFarland from Coterie, coming to us from Cincinnati, Ohio, and Lance Poole from Juniper Labs, coming to us from Denver, Colorado. How are you guys doing today?
Doing good.
Doing pretty well. How you doing, Rob? Lee?
Yeah, I'm doing great. Thank y'all for being on today. Cincinnati and Denver seem to be two hot spots in the world of InsureTech. It's exciting to have somebody else from both of those.
Thanks.
How do you explain that, guys?
Well, I can't speak for Cincinnati, but for Denver, you've got 300 days of sunshine. The Rocky Mountains are nearby. What's not to love? Well, everyone seems to be moving here from all parts of the country. So,
yeah, we definitely can't can't match that in Cincinnati, but
Yeah.
we've got the Midwest and a lot of insurance companies around us, though. We got Great American and American Modern, Western and Southern. Then, of course, we got our Columbus neighbors.
You do have a lot of insurance in Ohio, and you have something else that we were talking about before.
Oh, man.
And that's Skyline Chili.
Yeah. that's maybe a good reason. I will not bash on Skyline Chili.
Do not do that. I guarantee you'll regret it.
Yeah, I will.
Well, we're excited today because we have two enormous nerds on our show, which actually, Lee, we kind of have nerds on frequently, don't we?
I would say quite often. Yeah. Nerds make the world go round.
Well, yeah. I mean, they get things done. And so we have two actuaries on the podcast today. Why don't you guys take a minute and tell us the truth? What is an actuary and how do you get to be one? Lance, I'll ask that of you first.
Okay, so actuary can play a lot of different roles. The way I like to say it that no one understands is that an actuary prices risk. So we put a price tag on risk. I got there the very traditional way. Like many people, I got a master's in statistics. Don't you have lots of friends that did that? So, but instead of becoming Nate Silver and making lots of money and writing all kinds of interesting articles predicting elections, I became an actuary and priced insurance. Started out on the life insurance side of things, running models. Really, I think at the heart of it, it's trying to determine. One role is helping the company understand how profitable or unprofitable a product is going to be.
How about you, David?
I agree with that. I typically say we assess and quantify risk. I did not go about it maybe traditional. I was a history major in college, and then my senior year, I ended up falling in love with mathematics via a class in what's called formal logic, and so I had made the really dumb decision to switch my major my senior year, and then packed multiple 21-hour semesters in a row to try and figure out how I could get done as soon as possible. And the shortest way to get done was to take the actuarial route. And I didn't know what that word meant at the time. And when a girl asked me if I was taking the actuarial exams, I just nodded dumbly and said yes. And so now I'm an actuary.
It's a great pickup line.
Thanks.
I'm not sure what you're picking up with that line, what it picks up for you, but it is a good pickup line.
Well, I've heard that all girls love actuaries. It's just a well-known fact.
That's right.
So true.
Yeah, my older son, was told by his high school math teacher, because he was very advanced in math, probably like you all, that he should go into actuarial science. And so we kind of did some discovery on it, and it's actually like a really great, solid, strong career segment. Isn't that true?
Yeah, there's no doubt. I mean, the pay is really competitive. There's almost zero unemployment. You can quickly be making six figures after passing some exams. And the nice thing too, it sets you up to go do fun tech startup stuff like David and I are doing. I'm not sure about David's perspective, but my take is that if the music ever stops on tech startup land, there's always a couple of insurance companies that I could go work for.
Right. That's exactly what I was going to ask next. How do you get from the safety and security of being an actuary for a carrier or something like that into the crazy world of startups? Tell us real briefly how that happened for you guys.
As for me, I'll kind of go first on this. I started off more traditional in the actuarial space, working for a company your insurance listeners will probably know, NCCI, National Council on Compensation Insurance. And then I went into actuarial consulting, had fun with that. I then worked for a jewelry insurance firm. And then while I was living in Wisconsin doing the jewelry insurance thing, a guy from American Family Ventures was thinking about starting an InsureTech over in Chicago. And we just had some kind of ideation sessions on what that would look like. And then he ended up starting ClearCover, and he asked me to join him on that as chief actuary and head of insurance product. And the idea of starting an InsureTech, starting an insurance company, whatever you want to call it, was something that was always kind of alluring to me. So I joined in with Kyle and help with that. And then eventually that helped me come to this next stage of starting Coterie.
Cool. What about you, Lance?
Yeah, for me, it was I was running product development at a carrier in the Southeast, pretty young age. One of the things interesting about being an actuary, if you can actually look people in the eye when you talk to them, they'll promote you pretty early. So I found myself in management, and I convinced my company to send me to Stanford for an exec ed program, and really caught the entrepreneurial bug at Stanford. I guess now looking back on it, I'd probably caution against insurance companies sending young execs to Stanford because you go there and
They'll
you
never come
want to do
back.
cool. You never come back. You want to do cool tech stuff. So I happened to make a connection there, and we started a digital mortgage platform, like a white labeled Rocket Mortgage. And so that was my kind of first foray out of insurance and into something more tech related.
And so that was Maxwell, correct?
That's correct. Yep.
And then what happened?
Yeah, so Maxwell was doing well. We scaled it to about 30 people, and I got really interested in what was happening in InsureTech and thought to myself, why am I, as an actuary, running this mortgage tech company? And happened to have a neighbor who was doing some really cool things in the data science side of his MGA. And so we started scheming about what we could build, and that turned into Juniper Labs.
Very cool. Well, let's change focus here real quickly and talk about where we are today, which, of course, all four of us, I'm sure, are probably in our homes, sitting at our desks with our pajamas on and some kind of microphone in front of us because we're in the midst of COVID-19 and the whole coronavirus catastrophe that's engulfed the world here in 2020. And you guys, Lance, you put together a very interesting white paper on coronavirus and commercial insurance, kind of looking at past pandemics and seeing what kind of lessons we could derive out of this. So instead of me summarizing it, why don't we start with you by telling us why you did this and what did you come up with?
Yeah, well, the reason we did this is we were really interested in knowing what had been done in terms of the past look at economic impact. Yeah, and I guess really we started with the question of what's the future going to look like? What's in store for us the next 1 to 2 years? And we really didn't think of any way to answer that apart from going back and looking at what happened with Spanish flu, what happened with SARS, what happened with the 08-09 recession. I think in the time too, we were hoping to find something encouraging as well. A lot of the press these days is not all that encouraging, and so we started out by just this hope of, can we find some good news in there somewhere?
Tell us about it. What did you find?
Yeah, so what we found was that things that were the good news is that, one, businesses can bounce back pretty quickly. So if you looked at the 08-09 recession, we saw a really high, what we would call, recovery rate. So when one business fails, there's another business that is founded to take its place. So that would be a recovery rate of, say, like 100%. And you probably see this around. If a restaurant in your neighborhood goes out of business, another one is started, within a couple months to take its place. And that's what we see in the 08-09 recession, is that if there's 700 restaurants that go under, there's 725 the next year that are founded. So for us, that told us that, one, carriers could expect to see higher churn. There's going to be businesses that go under, there's going to be ones that start again. But then, two, it's going to tell us that at some point we are going to come out of this. So this too shall pass. The other thing that was really interesting is we are just terrible at predicting the future in general. If we looked at some of the reports that were done in 2005, 2006 on what could happen during a pandemic. And what was really interesting is that these reports, one from the U.S. Department of Health and Human Services, predicted that around 2 million people could die in the U.S. in a pandemic. So they're sort of in line with high-end predictions of what could happen. But the economic cost they predicted was just nowhere near where we are. So their economic prediction was this could cost over $250 billion in terms of economic toll. So they associated 2 million people dying with $250 billion of economic loss. and we're going to be at 10x that amount.
Right.
So I think that's fascinating to see too, that some of the ports got the mortality impact, if you will, and the impact of the human suffering, but just the economic toll is far greater than anything anyone could have ever thought.
Are you surprised then by seeing what's gone on and what's going on? Like you said, this enormous number, tens of millions of people unemployed. Knowing what you know now, does it surprise you?
Yeah, I mean, I think I'm surprised just with the amount of shutdown that's had to take place to ensure that the virus doesn't spread, and the impact that's had. You think even just shutting down the country for a couple of weeks has enormous economic impact, and of course, it's the right thing to do based on what's happening, but the corresponding toll is surprising.
So, what is your thought with the world of insurtech startups? Will we see the same averages of failures and then startups next year? Is there still money out there? I mean, what do you see happening with the world of insurtech startups?
Yeah, so insurtech startups have a really unique opportunity here to make adjustments. So one of the things we talk about in the white paper is that as carriers, you should really be evaluating your assumptions. So if you are pricing, workers' compensation, that product may be priced on assuming that the world is continuing to go up and to the right, that payrolls are going to go up, but as we're seeing, payrolls are not going up. If you're working in the private auto market, you're probably pricing your product, assuming a level of driving activity, and so for insurtechs, they have a lot of opportunity to change quickly, where it might be harder for an established carrier to make some of those changes as quickly as an insurtech. And in terms of raising money and what that could look like, that's probably a great question for David to answer. I know that Coterie has closed on some funding as well,
Right.
relatively recently, if I'm correct, and so that might speak to what insurtechs could expect to see from that side.
David?
Yeah, I can get into that. So we're in a super fortunate position, and I'd love to say like we're really smart and we're able to predict all this, but that's completely not the case. We end up closing on a fairly significant Series A about 2 weeks before all this went down. So I again super glad that happened, but clearly not every insurtech is in that position. So there is some stuff working against insurtechs in that respect, but in another respect, to Lance's point, they have some nimbleness and agility that they can work with. And one of the biggest things that I think is going to come out from this is their ability to change based on the data that's coming in will probably be the biggest asset to them. And what I mean is this: we basically have this, we built up all these tools, right, that we can use, that all this data is coming in and it goes through these tools and we pop out an answer, right? And in legacy world, the legacy insurance world, things move slowly. And so they're not able to change the machine very quickly if there's anomalous data that's coming through. But in the insurtech world, they have, I guess, more agile systems to where if they do have this anomalous data coming through, they can make adjustments. And I'm just going to take an example of private passenger auto, right? So right now, in the private passenger auto world, for your Progressives and Geicos and whatnot, they base everything on financial responsibility, household makeup, lapses in insurance. Those are pretty significant factors. And right now, if you look at what has happened, you have all three of those things largely skewed because of what just went on, right? Like 20 plus million people are out of work. So these people who are more traditionally fairly good risks, now they have this ding of like, hey, I'm out of work. Their financial responsibility score is probably hit because of that. And simultaneously, no one's driving, right? Mm-hmm. So I'm out of work now, and I'm not driving. And so I'm probably not going to pay for car insurance. So I'll go ahead and let that lapse. Why bother? Right. I don't need my car this month. And so now you have this go on, right? Good risks who are letting insurance policies lapse and who have, financial dings and may even be moving in with mom and dad. And in a couple of months, they're going to get jobs again. Their driving behavior is probably going to be better than ever because they're you're probably not going to drive as much. And they're going to go out looking for insurance. And based on the insurance models that are currently there, they're going to get rejected by just about everyone. And they're going to have these premiums that are sky high because they have lower, quote unquote, financial responsibility, at least based on the models. And they let their insurance lapse. And the cool thing is InsureTechs can think about that and make an adjustment. I'm not confident that the legacy carriers will be able to make adjustments so quickly.
But the thing that the legacy carriers have are deep pockets.
Absolutely. And that's the big benefit on their end. Now, new business though is a pretty big component of what these legacy carriers are going after. And if most of their new business dries up, that is going to hurt them. But to your point, I think it's your point, they can weather that storm.
Mm-hmm. Or to your guys' term, they could survive instead of thrive.
Exactly.
Yeah, there's also a lot of, there's an expense issue to be dealt with as well at bigger carriers, and it's a little harder to sometimes trim on expenses. So as we've said, exposures are going down on almost every product line. So you have, less premium to cover the given expenses, and so you're going to need to make some trims. InsureTechs, there's been several InsureTechs that have laid off a lot of people pretty quickly. Metro Mile, if we talk about the auto world, they laid off 100 people, a third of their workforce. A big established carrier, Travelers, isn't going to be able to lay off a third of their workforce. At least I hope they don't for the unemployment number's sake. So I think that's another place too. If you're an InsureTech, you don't have the deep pockets, but also you can be pretty nimble in terms of trimming quickly in order to save on expenses.
Sure. And I think a lot of people never had any idea of what an event like this might have meant to their business model.
Yeah.
Like Metro Mile, that's based on how much you drive.
Right.
That it would go from we don't drive a lot to we don't drive at all. That's pretty threatening. Let's talk about one of the things that we've seen recently, which is like return of premiums. My insurer is sending us back at our house, is sending us back money, rebating us. I don't know exactly what you call it. What do you think about that as a strategy?
It's a little bit of a strategy. It's a little bit of just anticipation. Some states have kind of already started mandating that for the period where there's not really any exposure, you need to give back premium. And so in the name of adequacy, it makes a lot of sense, right? Like if there's no exposure, if you're not driving at all, you probably should return some of that money. We do this explicitly, like we do this like as function in the workers' comp world, right? You forecast what's going to happen in the year, and then you have your premium audit after the end of the year. And if you didn't really have that many workers, you give back premium. If you had more payroll, then you take more. I think it's just like the personal auto world and other lines are going to do this too. So it makes sense from an adequacy standpoint.
Yeah, I got back $30, or I'm due to get back $30 from my carrier. So it's every dollar helps, but my takeout last week was $70, so it's not quite covering the expenses as much as I would like.
Let's talk about claims. We love claims. We're in the claims business. What is this going to do to claims? What's your senses there?
I'll let David jump in on that.
This is going to be super interesting. All right, so claims in various lines of business. Workers' comp. Let's go into workers' comp for a minute. I know you guys are mainly working on the property side, but I think this will have a lot of impact on the workers' comp claim side of things. So usually in recessions, when you lay off a bunch of people, you end up having a lot of workers' comp claims. And the reason is some of them are legitimate, right? Like this guy has been working for years. He hurt his back and he just decided not to make a claim because he's just continuing to work. But now his job's potentially on the line. So he's like, hey, I should probably go ahead and make a claim about my back issue before I get canned, right? That happens. So you sometimes see an increase in claims during recessionary times. You definitely see moving forward when the recession improves, so you start coming out of recession and people start hiring, you end up seeing more claims. And this is largely because these employers end up hiring people who are, by the fact that they are being hired, new to the job, right? They are new hires and somewhat less experienced in what they're doing. This can be even more true or more impactful in the cases where you have mass redeployment of skill sets. And if we look at what we're going through right now, where we have all of these, particularly restaurant and retail workers who may not be going back to the same job that they were at before, largely because, frankly, people are not as inclined to go to restaurants and brick and mortar stores, you're going to have a complete redeployment of skill sets into these other areas, like whatever, furniture making possibly, because Wayfair stock is up like 48%. And that's going to end up causing a high amount of claims in, let's say, the workers' comp space. Now, the interesting thing about that is in workers' comp, what you're going to have simultaneously is you're going to have a sharp decrease in payroll, right? Because everyone's getting laid off.
Right. And in premium.
And premium. Yeah. Therefore, the premium is going to go down. So workers' comp carriers aren't going to be thrilled. You've had a series of rate decreases over the recent years. So now we're probably going to get to the point where we're hiring on new workers, right? So probably lower payroll than the previous guys, yet we're going to have higher claims rates associated with those guys. And yet we're not going to have the premium to account for it because the rate increases have not come in yet. So I imagine we're going to have some wavy times for workers' comp coming up, simply because you're going to have rate increase after rate increase to try and catch up with all of this. And clearly the insurance companies aren't going to get the return from the investment side of things to help with that. So it should be an interesting time for workers' comp.
Lance?
Yeah, the other place that's really interesting is what's happening with business interruption coverage as well. I mean, that's kind of the talk of the industry right now, is to see what's going to happen there and whose claims are going to be paid out. And I can't predict the future there. I've already talked about how bad we are at predicting the future. But I know there's enormous pressure on carriers around those claims. And I think that's part of what you're seeing with some of rebates and other things that carriers are doing to show the good that they're doing in the industry, to hopefully get that in front of regulators so they can show some evidence of giving back.
So with all of this that's going on and try not to predict the future, I mean, right now we're talking to two really smart guys who know insurance, they know risk. How will the future of the insurance policy change? I'm just thinking out loud here. We're going to have to ask different questions now. Now with this pandemic that's happened, we're going to have to rate policies a little different, right? Am I thinking that right? What do y'all think about that, Lance?
Yeah, I think we're definitely going to see the application change. We're going to see forms change. That's part of what you're seeing with InsureTechs right now, is attempting to ask different questions. I've heard a great story from an underwriter who created a program in the 90s who said the only question they would ask for contractors is, how old is your truck? Because if you had a new truck, you must have been doing really well with your business. Versus if your truck hadn't been replaced in several years, then what's wrong? So there was this one question that could get to the essence of the risk. And so I think that's part of what we'll be seeing, is different questions that help undercover the underlying risk. And the proxies will need to change. I mean, before, your credit score and your continuous coverage was a proxy for the risk. And going forward, that's going to change. And so the questions that need to be asked will change as well.
David, what do you think about that?
Yeah, absolutely. I mean, as far as like the forms itself, transparency is going to have to increase. I'm curious to what level it's going to increase, and what we're going to see on that side. I assume it's going to be pushed by regulators rather than the customers, because generally we don't see people care about insurance that much. And I don't want to sound negative, but I'm not confident that even this pandemic will cause people to really look through, a 200-page policy, right? Like maybe it will. Maybe people will really think about insurance more, but I'm not confident about that. What Lance is saying about rating in general and the assumptions that we have and how we can identify risks, those are key parts that will need to change because of this anomalous data that's coming through.
David, I want to ask you about BI as somebody who works in the commercial insurance space. What are your thoughts there? Right. Business interruption.
Yeah, business interruption. Yeah. So basically, for those who don't know, but I think most of your listeners do, what happens is if your business is shut down for a particular period of time, if you have this coverage, the insurance company will pay the loss of income during the shutdown. Now, post SARS, most of the insurance companies in the United States said, yeah, we'll sell business interruption insurance, except we're going to exclude communicable diseases or pandemics and stuff like that. There are also other types of exclusions on insurance policies that are similar to this. But clearly, like, this was not a big issue in the United States up until today. And so now we have this instance of many claims of business interruption insurance where these companies are advocating like we should get some type of indemnification, some type of being made whole, right? Like paying our income because we were forced to shut down. And the problem is the insurance companies are saying like, look, we simply have excluded this. We put it in writing. It's a big exclusion. It says no. Right. And things are kind of being fought right now about like, well, should the insurance companies pay? Should they not? And if the regulators do this, if they do make it so that insurance companies need to pay, it's going to cause a huge unfunded liability. The insurance companies did not collect enough premium to pay that. And so it's going to put tons of strain on the insurance companies. And then going forward, you're going to have these insurance companies who will willingly give you this coverage. Some will, but it's going to cost you a ridiculous amount to get it. And so like it's one of those situations where like, I don't know if most of these businesses are going to be willing to pay $25,000 for business interruption insurance to include pandemics.
Right. The kind of premium to make it actuarially sound.
Right. Exactly.
Would be unheard of. Lance, any thoughts on businesses through this?
The other dynamic that's at play here is that many of the carriers that, as David mentioned, this liability that's out there, if they were to have to pay these claims, many of those carriers are small regional carriers that are supporting small businesses. So not every carrier is Travelers or the Hartford. There's a lot of small regional companies that would go under if they were faced to pay out these claims. And there's a lot of small businesses that's who they rely on. And if their insurance company is bankrupt, has been put into receivership, then they're going to have a hard time finding coverage. So I think it really kind of undoes what the government is trying to do with a small business bailout. It just creates another bailout that's going to happen of insurance companies if they're going to have pay these claims. And you're talking to actuaries who think a lot about how was the product designed, how was the product priced. The product wasn't designed to cover this kind of event, this kind of a loss. So it would be really interesting to see what happens, but I have a lot of concern for the small regional carriers if they're forced to pay claims.
We see something similar to this with earthquake insurance. And one of the things I'm hearing, I live in California, and of course we have earthquakes, and earthquakes are excluded in like every policy. You have to pay either into a risk pool like the California Earthquake Authority or private earthquake insurance. It's all very expensive. But one of the questions is, if there were a significantly catastrophic event, would the government come in and maybe push on carriers to change the coverage after the fact? Do you guys see that as even possible through the courts?
Unfortunately, it does happen. It's happened many times in the workers' comp system where you have this kind of somewhat ambiguous, it's not even ambiguous, it can be fairly explicit language, and courts, many courts will decide, no, we think this is how it should be interpreted. And NCCI, I used to do this all the time for NCCI, will write up these memos saying like, hey, this is going to severely negatively impact your workers' comp system. Carrier's going to lose lots of money, and you should really reconsider this because it creates this huge unfunded liability. And I mean, it happens. Now, looking at something that I think we all can remember is back in 9/11. That was something, terrorism and terrorist events are usually excluded in your insurance policy, right? Like we're not going to cover those things generally. But clearly people needed help when that happened, businesses specifically. And so instead of just saying like every insurance policy must come with terrorist coverage, what we created was a federal mandate, TRIA, and that's been renewed on several other names. But that extra 3% of premium essentially creates a little bit of funding to help out when those types of events happen.
Lance, I want to ask you about the tail on this. One of the interesting things to me about this pandemic is we're writing the playbook kind of every day, because though, like you said, there's been thinking on this for some time. You mentioned back in 2005. And I've even heard of more recent planning that was done by various government organizations. It seems that because of the particular nature of the disease of COVID, that we have to judge this kind of every day how it goes. What are your thoughts on there about the tail of this thing and the effect that that's going to have? Because we're not done with it today. I mean, we're not done with it apparently or seemingly until there's some kind of medical relief for it. What's your thought?
Well, it's been said that hope is not a strategy. As much as we want to hope that things get better, I certainly do. I sort of hope that we're back to work, that things have resumed. I hope that my kids can go to summer camp, all those things. But that like we're saying, it doesn't mean that's going to be the case. If you look back, just to give you kind of two ranges, if you look back at the Spanish flu of 1918. From what we've read in our research is that by 1921, by and large, the company was kind of back to pre-pandemic levels. So that's kind of 2-year range. Obviously, the ability to treat Spanish flu and vaccine and the technology is not what it was then as what we have today. So hopeful that we can do something better than that. If you were to look at SARS, the Hong Kong economy, bounced back within a quarter or two from SARS. Now, SARS, only infected a little over 8,000 people, was contained to a small geographic region, and didn't have near the impact as what we've seen with COVID-19. So I don't think we should be thinking that we will be back to normal in a quarter or two, sort of what we call a V-shaped recovery. This definitely stands to be more of a U-shaped recovery, and could last as long as a year or two as what the country went through in 1918.
So do you think the economy today, the world today, is better equipped to deal with that than it was in 1918? I mean, you're talking about 100 years ago. Are we more elastic today, more flexible?
I think so. Things are more interconnected. So that's certainly very different than 1918. But I think the ability to treat this, I mean, it seems like the world's brightest minds are all focused on solving this one problem. So I'm an optimist by nature, and am optimistic that all those smart people, all those resources being thrown at this one problem will result in some solution. It's really hard to know what that looks like now, as we're all trapped inside our homes and working from home and having to stay 6 feet apart from everyone. But I'm confident that all those people will come up with a good solution.
What role do you think social media has played in this whole pandemic? Do you think it's helped us get communication out, or do you think it's hurt us by getting the wrong communication out? David, what do you think on that one?
Oh man, I'm probably the worst person to ask about this. First off, I'm an actuary, so I'm not very social. And secondly, I definitely don't have any social media accounts, but I read the news, so maybe that can inform it. I have not been super impressed with how social media has impacted things. The spread of information and potentially misinformation has caused spikes in panic in some respects. And it was one thing, like we're back a while ago, before we had these outlets, we would have news from somewhat reliable news sources. Whereas now we just have a lot of information that's flying around, and probably the most polarizing things spike interest, right? And so it lends itself to cause issues of hoarding and panic behavior and whatnot,
Right.
which is not ideal.
Lance, what do you think?
I agree with that too. I do think there's more of a recognition of some of the important things to do to help with the pandemic, help with social distancing. The word has been gotten out around the precautions we should take. I guess is a better way to say that. And I don't know without social media that would be, but as David mentioned, you get the good and the bad, right? There's this general awareness that's much greater than we would have without social media, but we also get all the bad in terms of the fear mongering that can go on as a result of this.
I would agree with you. I think that every night me and my wife go and sit on the couch. We always chat about what all we saw on social media that either helped or hurt the whole world of this pandemic. I think it can shape everything. That was just my thought about in 1918. Social media didn't exist.
Right.
And it does now. So it's a very different. It's a great way to get communication out, but sometimes it's that game of telephone, and just the message changes as it moves throughout the whole group.
I want to ask you guys about running an InsureTech through this. Let's talk for a minute about being the CEO of a startup through this process. I'm sure it's affected you both a little differently. Like David said, they ran into some really great timing vis-a-vis their funding round. What's happening in Juniper Labs, and what kind of challenges does this represent for you guys?
Yeah, for us, it creates opportunities. So that's is exciting that, as we've mentioned, there's new opportunity that it didn't exist a month ago. But the challenges are sources of funding. Raising VC capital is much harder in this environment. So we've tried to position ourselves to be in a place where we can control our own destiny, where we can be cash flow positive and not have to rely on VC funding as one capital source going forward. So that means we just have to be more creative in terms of ways to generate revenue. For us, we've got SaaS services, but I've also taken on a handful of consulting related engagements that we may have said no to earlier, but have said yes to because we think one way for us to learn, deliver value, but also brings in some cash in the door. Because the name of the game as a startup CEO is survival. I mean, you can't win if you're not around to take advantage of the opportunity. So for us, it's how do we extend our runway by 6 months or so? How do we create more cash now? And you have to get resourceful.
David?
Yeah, I think a strategy that a lot of SaaS products or even insurance products utilizes is like a negative initial cash outlay, right? Let's say your cost of acquisition, and then you make it up on the subsequent terms, right? So in insurance, you lose money on the first policy, and then you make money on the subsequent ones. This works really well if there's available capital. So most large insurance companies, they have lots of available capital, and so they can do that kind of stuff. Whereas InsureTechs were largely leveraging the essentially venture capital firms, private equity, stuff like that. That source of capital has, I don't want to say largely dried up, but it's definitely a little shyer than it used to be. And I think you're going to see a lot of startups kind of accept that, hopefully quickly, and make some innovative changes to how they get profitable. And so as far as like what that means for Coterie, again, thankfully we've had a good round that came right before this. We're largely focused on like building out our product, improving that, continuing to get partners on board. Thankfully, we had a decent unit economic structure, but just continuing to improve that. And really, I think the biggest thing is just investing in our people. Right now, there's like always, we as people kind of like these three sources of call it volatility, whatever, like three sources of stress. Like you have your family, like the people you interact with at home, you have your work, and then you have like this macro, like what's going out in the world. And right now, what's going on in the world, it's super volatile, lots of stress. What's going on with your family? For some people, it's much more stressful because they're with them all the time, right? There's a lot of time to be spent, and that wasn't always the case when you're heading to work. And for many, unfortunately, the work right now is a super stressful time because they could be cash strapped, or they're obviously not hitting their goals. And so what we're trying to do, at least at Coterie, is like continue to promote a sense of stability within the work, within that work environment. Still maintain some cultural events, like we'll hang out after work and do Zoom game nights. We'll do Zoom lunches, and just so that people have a little bit more of a
connection,
connection and stress-free outlet, right? Like just time that you can spend with your team. So we've been encouraging people just to get on Zoom and just chat, not necessarily about work, but just spend time hanging out with each other. While getting work done, we're pretty focused on our goals, but really making the cultural part important.
Lance, let's talk about ease of use.
Certainly.
I'm very interested in that. That's something I preach in our company all the time. And you guys are involved in that at Juniper Labs. Can you tell me what shape that takes for you guys?
Yeah, so we have a pre-fill product, and what a pre-fill product does is a company, it's going through the application process, can provide their name, location, website, a few pieces of information, and based on data that we have access to, can fill out the rest of the application ahead of time. So taking the time where it might have taken 10 minutes to go through the application down to a couple of minutes. And in a world where things will increasingly be moving more digital, we think that's a really important part of the process.
We had some conversations on some recent episodes about customer engagement. What are your thoughts there, and how does Juniper work with that?
So with customer engagement, one of the things we want to do is help to make the experience as easy as possible. That's part of how I think you can create really solid customer engagement, is by taking a process that could be long and arduous, and making it simpler. The other thing you can do is try and get really targeted, and try and deliver a person a quote that makes a lot of sense for them. Right. Don't ask someone that's a florist if they do boiler work, for instance. So using what you know about a business to make the whole experience of applying for insurance more engaging.
Mm-hmm. And just by making it smarter, if you will.
Yeah, that's right. I know that David and Coterie's done a lot of work there as well, and can speak to customer engagement just as well as we can too.
Yeah, I mean, a lot of this is, I think, based on some sessions Lance and I have had in general, talking about how to make it a more friendly user experience. But what we like to do, we just have this thesis that people don't generally care about insurance. And so if that's the case, like, they probably want to make that application process the least time-intensive thing, but also the most accurate thing to get to what they need in terms of insurance coverage. And so Lance said it well, right? Like, you should not ask an accounting office if they have a swimming pool, right, or a play set, right? It doesn't make a lot of sense. And so what we can do is we can take data from sources that are veritable, that are true, right? And we can take that data and understand the risk, hopefully to the point where we can provide a level of coverage information. But what we can also do is we can tap into, let's say, software that you're already using to run your business. So now, you have the SaaS product that tracks your revenue or payroll or something like that. Well, it turns out most insurance is based off of revenue and payroll and stuff like that. And we can take that information in via API, get you an insurance policy that is commensurate with the risk that you exhibit, and as tracked by those systems. So that way you're not printing off your income statements every single year, or projecting out what your hiring plan is for the next 12 months and then running crosstown to your agent. Instead, right, it's just all hooked into the systems that you're using.
Yeah. Well, we're about out of time here.
Yeah, I'm sorry we ran over you guys. I apologize.
I understand. I understand how easy it is to, just continue talking to actuaries. We're pretty enthralling.
I loved it. It was actually really good.
I can't believe how hard you guys are on yourself. I mean, actuaries are like the cornerstone of this business.
Yeah. Super smart people.
You have to be self-deprecating, I guess. That comes with the territory, right? Poking fun at yourselves.
They test on it.
Being an actuary, I mean, let's be honest. It's a pretty nerdy job.
Right.
Oh,
come
yes.
on, guys. It's a nerdy job.
Yeah, definitely.
It's pretty nerdy.
You're talking to more of the two outgoing actuaries there are. So.
Yeah, I was about to say y'all are not the typical ones I would think about.
I want to go to an actuarial conference. What's that like?
It's probably like that HR conference I went to.
Yeah. Yeah, I mean, you can find, you find a wide variety of people. There's a, range, just like at any conference. But yeah, by and large, the social skills will not be all that high. Probably we have the most fun when the conference is in Vegas and we can go play poker or use all the probability skills we have to our advantage.
Do you do well at the tables as a result of your education?
I feel like I do pretty well. I really like to play poker. Have enjoyed that. I obviously can't play professionally or anything. It's like, just for fun with home games when that was allowed. But yeah, it's like using that part of my brain for sure.
Help us here. What games should one play in Las Vegas and what games should one stay away from?
I mean, as far as the highest probability, roulette, right? Like, isn't that the highest? I mean, you're still negative expected value, but I think that's the highest, right, Lance?
Yeah, that and then craps is like pretty good as well too. And then blackjack, if you can play blackjack like completely by the book, in terms of when you double down, when you hit, that sort of thing, you can do okay there too. Again, you're still going to lose money in the long run, but it's a way to kind of minimize how much you lose.
Okay, well, here's the deal, guys. This year, if there is an InsureTech Connect, which they say there will be, and when we're all there, we're going to the casino. Lee and I are going to the casino with you two.
Yes.
Okay.
Yes, with you too.
We're going to tag along. And we're going to expect to win. And if we don't, we'll contact Coterie and we'll take out a policy
send the invoice.
That's right.
That sounds great. I'm in.
Yeah, sounds good.
Listen, we really enjoyed having you guys with us. And this is our initial actuarial episode. So I think I'm happy. I think it went well.
I'm very satisfied. Yeah, very satisfied. I liked it a lot.
Yeah, it was a blast. Okay. It was a blast to be on, and thank you guys for having us on.
And I really have to mention you by name, Lance. Thanks for coming, and you too, David. Thanks for being with us.
Yeah, thank you so much.
Thanks, guys.
Thanks, Rob. Thanks, Lee.
I don't think actuaries are funny.
Why do you say that?
Well, I mean, they were regular guys. Why are they so hard on themselves?
I don't know why they're so hard on themselves. I would like to be their friends.
Not only regular guys, but really intelligent, bright people who know insurance well and had a lot of interesting things to say.
I agree. I thought it was a very interesting conversation. I think that they even had things that they didn't have time to say, but they look at this whole thing from a different perspective.
Agreed.
Because of where they've been, right? It's very statistical. And even that whole white paper is very statistical driven. So it was a great conversation.
But, as far as that went, the white paper and what came out of that, I think that a lot of it was kind of hopeful that maybe, maybe economically and socially we'll be able to bounce back. Although there's some things that socially I hope, we don't bounce back too quick.
Like what, Rob?
I like being at home.
You like being at home?
I like not having to travel all the time.
Yeah, I've heard that from a couple of people that they enjoy staying at home, and that they're okay if they stay at home a little longer.
Yeah, but overall, I think that great thing about our country is we're super resilient, and so I'm sure that we will forge forward as quickly as we can.
Yeah. And that's what it seems like, right? It seems like we're moving forward, and it's a very interesting time right now, but yeah, I think so.
Yeah, and a couple of interesting companies with interesting stories using data to make a difference in insurance. It's kind of cool. Good stuff.
Yeah. I'm glad they were on.
We thank Lance and David for being with us, and we ask that you check out their companies, Juniper Labs and Coterie, and that's it. And until next time, we thank you for being with us, for being part of our little experiment here, and
goodbye, everybody.